thing my entire life has always been manage risk as the information comes in. And if the information changes and your position is wrong, guess what? Change your position. That's why I find the best traders, you know who the best traders are on Wall Street? They're women. You know, Bitcoin is actually a better risk-adjusted opportunity today at 20,000 than it was when I first got involved in it in 2016 at under $1,000 US per Bitcoin. And everyone will say, how is that possible? And I'll just say three things: adoption, the response to COVID, the government response to COVID, which was unprecedented, $9 trillion of global money printing. Okay, unprecedented in the great financial crisis. I mean, you know, there was maybe $2 trillion. Now we're at $9 trillion. And then the most important part of it, it's 5 years down the road. It's worked for 5 more years. It's security, the network security is higher than it's ever been, or close to as high as it's ever been. All of these indicate that the likelihood of me attaining my price target is actually higher. So even though it went from 1,000 to 20,000, 20 times higher, it's better today, more likely to attain my final price target than it was 5 years ago. I cannot, for the life of me, understand why people don't see how simple this is. But they look at the donut and they focus on the hole. They don't focus on the donut. They focus on the hole. They're like, well, it was at 70 and it went down to 30 and oh my goodness. And well, you grow up, people, learn how to manage risk, okay? This is the opportunity now. Even at 70,000, I thought it was cheap based on a credit default swap analysis. By a credit default swap analysis, I think Bitcoin should be trading at $400,000 today, just on the CDS analysis. But it's not. And it's not my price target either. But the point is, using another mathematical way of looking at it, 400,000, it's 1/20th of its price. So all I will say is this is a tough sale to a lot of people. What we need to do is get the education out there. Like, I really cannot, for the life of me, understand how people who are paid to do smart risk analysis still have their head in the sand when it comes to this asset class. Fidelity, which has, you know, it's a top 5 global asset manager. It's done incredibly good research. It has Urian Timmer, who's, you know, he has price targets of over $1 million on Bitcoin using things like cell phone adoption comparison and internet adoption comparison. The Abigail Johnson, the CEO of Fidelity, has been testing Bitcoin mining for 10 years. And they've come out with this research, and they, as you know, in the USA are accepting Bitcoin in 401k accounts, et cetera, et cetera. They're getting pushback from some of the US senators who are brain dead financial risk managers. That's okay. What the more important part is the BlackRocks of the world, which compete against Fidelity, and they're both going to have the same client. And if the client comes to BlackRock and says, I'm going to move my money from you to Fidelity unless you provide a Bitcoin silo, BlackRock will really quickly provide a Bitcoin silo. Here's what I do know. The other guy that I think is becoming a Bitcoiner, and I'm not going to put these words in his mouth, but I saw him on CNBC the other day, Mohammed Al-Arian. Now that guy is smart, okay? I'm not knocking all risk managers as not being sharp. Al-Arian is smart. I know he knows the benefits of a diversified portfolio with asymmetric return possibilities. Asymmetric investments define careers. If your 1% allocation to Bitcoin goes up 100-fold, that is the possibility here. And this is why you cannot afford to have zero. Because if you have $100 in non-Bitcoin and your competitors have $1 in Bitcoin and 99 in the same stuff that you have, you've just lost out to the best asymmetric return ever, and your unit holders are going to be bitching to you, like we just talked about. How could you have missed this opportunity? People are very, money is so precious to them that they make irrational decisions all the time, okay? The irrationality of it is due to emotions. When you let emotions impact your investing, you tend to make horrible investment decisions. Some people hate Bitcoin. They can't get over it. Peter Schiff is that type of individual. I'm afraid that Shifty Pete has got to learn to change his portfolio allocation when the information changes. The point is, please, guys, remove emotions from your trades. Remove emotions. And that's why sometimes computers are better traders than humans. Computers trade based on price with no emotion. When something hits a price, it buys because it's programmed to buy or sell. The emotion of the person, the emotion of the person who is making this decision or programming the computer is different. But you cannot allow yourself to fall into these problems. Volatility is the price of return, okay? If I show you an asset that has very low volatility, chances are its return profile will bump around just above zero, okay? Here's the craziest thing. You know what vol measures, right? It measures, okay, so I'm trying to draw a graph on your screen. Top left to bottom right, a straight line down. No volatility, straight line down. Is that thing non-risky? No. You've lost money from there to there, but there's been no volatility. It's gone straight down. People who measure risk by using volatility forget that you can be in a straight line down with no volatility and still lose your shirt. And the same thing applies to a straight line up with sawtooth, okay? Even though you got to look at the regression to the mean. This is what's happening. Don't focus on this thing. Value at risk is all based on volatility. Sometimes it's asinine because they'll say, hey, you can have all of this. Oh, and guess what? Over time, it goes straight down with no vol. Straight line down. All of these systems were built at times when, computers, they're going to make my life so much easier. Sometimes they don't. Sometimes computers mess things up just because you're able to measure so many different variables at one time. I've done this for 35 years. All I bring to the table is 35 years of mistakes, okay? And I learn from every single mistake I make. And the key is not to keep making the same mistake. And the very most important key is remove emotion and cut your losses. Ride your winners and cut your losers. Whereas most people do the absolute opposite. They like to crystallize their gains. They like to be able to go to a cocktail party and say, haha, I bought Bitcoin at 100 and I sold it at 500. They forget to tell you that now it's trading at 15,000, okay? But they wanted to crystallize that gain, so they sold it at 500 and now it's many times higher. And then they never tell you about that penny stock that they bought at $10 that's now trading at $2, but they're praying that it comes back to $10, right? Because they kept their losers and they sold their winners. So again, Stephan, I bet you in my life, I might have a 60% batting average on winning to losing trades, okay? And that's way above average, I promise you. And that being said, the only thing I do well is on the 40% of my losing trades, they're gone. I'm not emotionally attached to them. The worst expression in managing money is we were early. You were wrong for the time frame that you said you were early, right? I say, I've spent my life as a trader, okay? I have a core holding in Bitcoin. I will never be short Bitcoin. But are there times that I trade it? Come on, guys. I'd be lying to you. Of course I traded. I've done this for 35 years, okay? Then they'd say, all right, what's your ideal or what's your core holding? Well, I'll share with you that my core holding is above 25% and less than 50%. They'll be like, why aren't you 100%? And I go, because you don't have to be 100% allocated to this most beautiful asymmetric return in order to reap the benefits, okay? And when you're not 100% allocated, what it means is you can take some profits, you can wait for the price to potentially come back down. If it doesn't, you're still above your core holding number. And I'll talk to you in 20 years. I think that there's a lot of people out there that should actually just DCA and hodl until they get to their portfolio weight. But then there's other people. Bitcoin Tina has admitted that, he has now realized that perhaps his weighting was a little too high in Bitcoin, and he didn't sell enough when it was above 50K, because now he can't buy anymore when it's below 20K. And now he wants to actually reevaluate his path forward. My entire life has always been manage risk as the information comes in. And if the information changes and your position is wrong, guess what? Change your position. That's why I find the best traders, you know who the best traders are on Wall Street? They're women. Women are actually better traders than men, I've noticed on Wall Street. The male, I'm too proud to admit this loss. I'm going to show the market who's right. I'm going to bully the market to see that very few people are bigger than the market, okay? And when you become bigger than the market, you probably become something like the JP Morgan whale that almost brought down the whole bank on a credit default swap position. Please, people, manage risk properly. Understand that there's nobody who has 100% batting average. Nobody. And think of baseball, where, a 300 batting average is like outrageously good. Maybe it takes time to learn that. The best way you learn it is by losing money, unfortunately, but that's generally the only way you learn.